In this video, we're going to talk about how I generate passive income using 5 stocks. That's right, I generate more in passive income using these 5 stocks than I ever did at the 9 to 5. So stick around. I know you're going to like this one. Hey, welcome back, everyone. It is time for another passive income video. We're going to talk about this because a lot of people hit me up saying, hey, John, how do you generate passive income in retirement? So that's what we're going to do. We're going to talk about how I do that. I use closed-end funds. I do not use mutual funds. We're going to talk about why I don't use mutual funds. We use closed-end funds to generate passive income. Now, I could say I also use stocks and stocks that pay a dividend. That can be considered passive. Passive income as set it and forget it, meaning I invest a certain amount of money in these closed-end funds. I set it and forget it. I do not look at the stock price. I do not watch the stock. The only thing that would make me look at the stock is if they increased or lowered their dividend. And then at that point, I'm going to reevaluate. When we invest in closed-end funds, we need to understand what the mission of the closed-end fund is, and that mission is how they generate the dividend they give to their investors. Okay, that's very important. And you need to understand what a closed-end fund is. So we're going to talk about that. We're going to start with what is a closed-end fund, what is the mission, and then we're going to talk about that monthly dividend and an idea that you and I can use to generate more dividends. And of course, I'll give you the list of my top 5 closed-end funds. We got a lot to do here in a very short amount of time. So let's go ahead and start with this. The closed-end fund is quite simple. It's called closed-end for a reason. Closed-end fund means this. A company, in this case, Columbus, they are going to create a fund. And what they're going to do is they're going to put a team on that fund. They're going to say, hey, Joe, Sue, Mary, Bob, we're going to have you run this Columbus fund. And it's going to be a high income fund for which they're going to generate their dividend using high income, let's say, debt. We're going to talk about that. That's the mission part of this. But what they're going to do is they're going to establish this team. And that team is going to take the money that they generate via an IPO. Initial public offering. So Columbus, being the company, says, hey, Greater Stock Market, we have this new fund. It's going to be CHY. That's the ticker symbol. It's going to be CHY. It has a name. And we're going to sell you shares on an initial public offering. Now, that money that we generate, because they're going to sell X amount of shares, say they sell 200 million shares. Whatever they generate in that IPO, that initial public offering, they're going to keep that money. And that's the only money they can use to invest to generate the dividend. The closed part of it, there's no more money to enter, which means the shares will not get diluted, right? Because if you do this closed-end fund, if you do this IPO, and then 3 years from now you put more money into it, you dilute the share value. So they're not going to do that. Closed-end fund. Okay, so now we have to have a mission. We have to say, hey, look, we're going to generate this dividend monthly, and we're going to sell debt to do it. So using that IPO money, they're going to go into the debt market, buy it, and they're going to resell it, make money, pay us, the investor, the fat dividends. Okay, this is why the dividends can be a bit more pricey or more lucrative for us. You have an active team that's going out and executing on the mission. See, if you buy a mutual fund, you're buying a basket of stocks that fit a sector, and it just ebbs and flows with the market. So for the most part, they will promote those mutual funds as aggressive, moderately aggressive, passive, right? Because they're investing in stocks and stocks that fit that mission of the mutual fund. Well, a closed-end fund draws outside the lines. They're going to buy debt. They're going to write covered calls. They're going to do all these things to generate that dividend. But see, it's very specialized. Remember I mentioned Bob, Sue, they're all in that room focusing on the mission. If they're writing covered calls or buying debt, that's all they do. And then they generate that dividend. Okay, so that's the mission. So now we know what a closed-end fund is, why it's called closed-end fund, how they get their money, and how they come up with a mission. And now they act upon that mission. So now imagine this team. They're in there, man, kicking ass. and they're then distributing the profits via dividends. That's what happens here. Every single month, they're distributing the dividend. This is why closed-end funds are fabulous for income seekers. You need income? Why not use a closed-end fund? You're going to get it. You're going to get it monthly, and you're going to be able to make more of it because in this case, notice the Columbus Fund, CHY, pays about 10 cents per share. 10 cents per share. So that's going to be about $1.20 per year in dividend distributions. Go ahead and take that $1.20 and divide it by the current share price. That's what your investment is paying you. Now you can use that money monthly to pay the bills, or you can drip invest that money. Okay, and this is that little trick where you can actually make more dividends. What you do is you buy your shares of Columbus CHY, and then you turn on the drip investment portion, right? You turn that little feature on, dividend reinvestment program. What happens is when that dividend hits your account, your brokerage goes out and buys equal amount of shares based on the dividend distributed. Distributed? Is that a word? Anyway, you get the point. That's what I've been doing for the past 11 years. So we go from, let's say, 1,000 shares to, as we move forward over the years, and say we fast forward into retirement, now we have 10,000 shares. See? And you did nothing. It was so passive. All you had to do was click one button, dividend, reinvest. As this investment is kicking down that monthly dividend, it's rebuying stock at the current stock price. So right now, if I were to get a distribution today, they would go in and buy equal amounts of shares of that distribution for $10.70. Now, it doesn't seem like much. Maybe you bought 1 share, 10 shares, 20 shares, 100 shares. It doesn't seem like much. But after 20 years, now all of a sudden we're talking real money. So that's a closed-end fund. And I'm telling you now, wealth managers seduce their investors, their retirement income-seeking investors, with these fat 10% yielding closed-end fund. Now, before I reveal my top 5, let's talk about that fat dividend. Because I'll tell you what, if you talk to most investors on the street, they will tell you this: the higher the dividend, the riskier the play, right? If they're producing a 1% dividend, that's like a treasury note, man. Okay, there's no risk, there's no reward. Now, as we amp up the risk, we amp up the reward. So again, risk reward. You invest in Microsoft, the risk is a little low, right? Little low. I mean, it's steady Eddie, right? The risk is not that high. Well, your dividend's not going to be that high. Microsoft distributes its profits in a dividend, so the riskier the investment versus the profit they distribute really don't connect. I'm trying to make a point here. Fast forward to closed-end funds. And to be honest with you, I should have used the mutual fund as the example. But now let's talk about this high-yielding closed-end fund. Again, they're yielding high dividends because obviously that's their goal. They want to distribute high dividends, but also they're luring in investors, right? We don't want this closed-end fund to go away, right? Bob, Sue, Lily, and whoever, they're in there working, man, they're busting their ass. Obviously, Columbus doesn't want to get rid of this fund, so they're out there working it. So they're going to try to maintain that dividend. Okay, so the higher the risk, typically higher the reward. But I think now that you understand how these work, you can kind of understand that it's not as risky as, let's say, buying a one-hit wonder stock or day trading. Now, again, your risk tolerance is not mine. Okay, you might be somebody that if this thing ticks 1 penny down, you're freaking out in the fetal position. Me, I've seen my investments in CHY go from $16 to $4. Never looked at it. Why did I never look at it? Because at the end of the day, CHY kept paying 9 cents a share. Now, let's talk about those top five favorite closed-end funds I use to generate passive income. So none of these are in any particular order. So get your pen and pad, write them down. Need you to do your research, right? How I feel about these things might not be how you feel. Okay, and I'm going to tell you right now, one of the main risks with the closed-end fund is they don't answer to anybody. We wake up tomorrow, the fund can reduce the dividend and the stock will get clobbered. That actually happened with CHI and CHY, and I'll tell you what was a shocker. They literally went from a 10-cent dividend to 8 cents, and the stock fell some $2. This is a $9 stock falling $2. Do the math, okay? So you have to understand what they do, why they do it, and that is the real fear. They answer to nobody. There's no earnings. There's no annual reports, monthly reports. No, they don't have to answer to anybody. So they actually can reduce or increase that dividend without asking its shareholders. Okay. So that's one of the major disadvantages if you're risk adverse. I'm not. So I don't care. Again, I buy these investments. I just want them to produce this fat dividend right there. You see it every single month. 22 cents, 22 cents, 22 cents. It's just ridiculous. So number one, QYLD. Love QYLD. Now you have to know what QYLD does. They sell covered calls against the NASDAQ 100. So of course, with the markets getting absolute worked, so does QYLD. We'll tell you about QYLD. They distribute their dividend as capital return of capital, right? So it is taxed differently. But if you're going to own QYLD for that dividend, you don't care. You're not going to sell the stock. Yeah, that's one of those big things. You go on YouTube, everybody's talking about QYLD because it paid 22 cents. That's fat. Well, then you'll hear all the naysayers saying, well, it's return on investment and your taxes, blah, blah, blah. Look, I want the 22 cents. I'm not selling QYLD, so I'm going to hold this investment, and it's going to pay me absolute ass-kicking returns. QYLD, love it, because when the NASDAQ moves higher, this thing moves higher and pays the fat dividends. Right now, it's paying something like 17 cents. It ebbs and flows based on where the market's at, the NASDAQ's at. Now, one of my favorites is ETV. Now, do you notice a theme? All of these are getting kicked because the market is overall kicked. Granted, the S&P has traded sideways over the past couple years, but these, again, they're going to trade with the overall stock market, and so that's where we're kind of at in this overall stock market. I love ETV. They use the money to buy right covered calls. They literally take all that money and they do covered calls. My specialty. They generate about 11 cents per share. And that's fat, man. On a $12 stock, you can accumulate some shares. Tell you what, that dividend is sweet. Keeping with the Eaton theme, another Eaton fund I love is EOS. They do the same thing. Buy right covered call. But I'll tell you what's different with this one. Over the years, they've taken their profits and bought back shares, increasing shareholder value. This is why ETV is trading for essentially $12, but EOS has traded as high as 25. They will buy back shares. They will take profit and not change the dividend. Meaning if they're kicking down 12 cents in a dividend, they will not take the extra profits and kick it to the investors. What they do is they say, here's your 12-cent dividend, just like we told you we would do, and we're going to take the rest of the profits and buy back shares. And when you remove shares from the market, what do? You increase shareholder value because now the shares that I own are worth more because there's less of them out there. Love EOS. Now let's talk about Colomas because Colomas is a mainstay. I've owned it since 2011. We got CHY. This again is a high income fund. Now what it does is this. The Colomas family of funds usually go out and they buy debt, right? They buy debt and sell debt. So that's how they're going to generate their income. So you have to think. Just like EOS and ETV, they generate their money right in covered calls. Well, in an upward market, call premiums are higher. ETV and EOS are going to go higher. It's perceived that they make money in an upward market. Well, think of CHI and CHY. They sell debt. So when they sell debt, they have to buy debt. So the higher interest rates go, meaning the higher they have to put money out to buy that debt and then to sell it. So this is why you'll see its stock move up and down. And it's very important to understand the mission, right? The mission is what they do with the money they got with their initial public offering and going forward, how that dividend is going to be distributed and if it changes, right? If the Fed reduces rates, that means the debt, CHI and CHY, is going to be cheaper. That means the stock will probably go higher because they'll make more profits, right? If the stock market tanks, call options are not as pricey, So closed-end funds like QYLD, EOS, ETV, they're going to go down. They're not going to make as many profits. So you have to understand the mission. Okay? So this is passive income because you make that investment, you set it and forget it. You can either have the cash distributed to you, you spend it, or you drip invest where you turn on that little feature to buy the equivalent amount of shares of that dividend distribution. This is how you build wealth. Okay? This is how you can take, let's say, your kids, maybe a grandchild, or whoever you want to help out. You create a little fund for them, put a little money in, buy closed-end funds like this, set it and forget it. And I'm telling you, if it's all favorable, right? If the past history is anything indicative of what goes forward, then you can pretty much bank that they'll maintain their dividend. You'll get distributed that dividend. You'll reinvest in those shares. And guess what happens the very next month? You'll get more dividends because you have more shares. And when you extrapolate that out 20 years, you have real wealth. Okay? Think of it as passive income, right? We are in the mode in retirement of wealth preservation and cash flow generation. We need cash flow on the table. How do we do that? We don't want to take risk. Using closed-end funds could help you with that. So I hope today's video about passive income and how I use it to put money on the table, pay the bills, helped you out. If you have any questions, comment below, send me an email, whatever. I love investing in closed-end funds because I literally feel I'm printing money. That's the mindset. We move numbers to try to make more numbers. And I think you know what I mean. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your investments be profitable.